let's move on. Okay, now this is when you download the strategies from into a spreadsheet. There's a wealth of information in that. When you download the strategy, you hit the history button or H button, and then it offers you the opportunity to download it into a spreadsheet, which I do get, you know, the year-by-year performance. But it also has a table of what is the contribution of each of the items in the, in this case, ETFs. Each of the ETFs in terms of total performance. It turns out that in this particular group, energy was 159%. Now, what that 159% means is like the total. You add this up for the total from your initial investment, whatever that number was. I should have added these all up, but energy represents 159, and dividend one was 0 here, but I see now I have a minus 15 here. I guess that would be the worst one in that group. And then in the next group of ETFs, again, the ETFs that are sectors are pretty much listed in alphabetical again. Biotech, which has gained most of it, and medical delivery the least. So it looks like every one of these has some contribution. Oh, way over there, cash. So when you look at the total performance of that strategy over its lifetime, cash has contributed 11.6% of the total performance, 10.4, 12. So cash has always been an important part of the SectorSurfer strategy. But each one of these, at some point throughout the years, and again, when you download this, it's a long, long list of each trade, when it was made, what was sold, what was bought. It gives you the whole history. And then this table gives you the percentages of who was the best contributor. And like, when we get into this group here, number 4, large growth, QQQ, was a major contributor. And down here, gold was the major contributor for this one. But you can see, now here's the 1X version of Treasury, 5%. And even gold, the 1X version, contributed 63% to the total. IVV, looks like it didn't contribute anything, it took away. And this international one didn't contribute. Bank here didn't contribute anything. And I think if you looked at these, most of them probably are, the contributions are probably the 2X. But every now and then 1X does add to it.
Don, what's the time period for each of these?
Okay. It goes back to the, as long as SectorSurfer issue up to 25 years.
Okay, so they're not all the same time period, each one of these, necessarily.
No, because the 2X's have only been out for a few years.
Right, okay.
So since they've been introduced.
Right.
That's maybe why some of the 1X are there, because they were there probably before the 2X's.
Exactly, yeah.
Now, on the very bottom, you got IVV at down 9%, and right above it is SPY up 112%. They're both the same thing.
Well, that's interesting you say that, because that question was asked to Scott in an email, just in a sequence I've been reading lately. Why did in one strategy, I think the guy was talking about energy, it was showing up as a major factor, in another strategy it wasn't. Again, I think it depends on the algorithm. The algorithm, I gather, Joe, correct me, I think the algorithms are adjusted depending upon the strategies that, I have a feeling it's not a single algorithm.
The algorithm is optimized whenever you make a change to the portfolio. So when you create the portfolio, there's at least 2 parameters, maybe more, that are optimized for that selection of assets over that time period.
Right. And I think that might answer the question.
Yeah, it's a different algorithm, so it picks different stuff at different times, sure.
Yeah. Okay, next.
That doesn't explain the absolute return of those 2 indexes, which are inherently the same thing.
Yeah, it does, because in one portfolio it got picked and the other one it didn't.
I thought those numbers were what those asset classes had delivered.
That's what it contributed to that portfolio.
Okay.
And it's not going to be selected at the same time.
Okay, here's a busy chart, but it lists in each column, each of the strategies, year-by-year performance. And then it also shows over all years, 10 years, so forth. And also we have S&P 500 here. But if we look at just at the first 4 Fidelity sectors, over 10 years, it's almost over the lifetime. They've pretty much done the same, except for strategy number 4 here is behind the other 3. But as you can see, each strategy has pretty much a negative year. And I would hate to create a strategy, and I found this out a little bit in some of my personal trading of, I think it was 2011, when some of my trading showed negative years yet. I think the market was up 2% that year, and I was down 3%. So, and a little story here, that was the year my son asked me to manage his account. That was the wrong thing to do that year. Luckily, I've made up for it this year. He said, "Dad, how come you're losing when Morgan Stanley is doing quite well?" Well, Morgan Stanley was buying all dividend-paying stocks. You know, they were really hot that year. So anyways, when we add all of these together, the strategy, you'll see the next chart, but let's stay right here for a minute. Here's the leverage one. We start off, it didn't really start showing up until 2001, and again, until about 2007 or so, the 2 X's didn't kick in. But what did kick in here was in 2005, it was still positive. But anyways, there was no year where there was a negative gain in this leverage. Also, if we go for 10 years in the income-oriented one, the only year that was negative was the first year, and I'm not sure why, but maybe whatever year. Bonds did poorly in '94. I thought '98 was a bad year for bonds. But anyways, all the other strategies have some negative years, pretty much.
So does SectorSurfer allow you to download this of all your strategies?
Yeah, this is when you hit that history button, it gives you year-by-year performance of
Right.
the strategy.
Right, but does it do it for all 10, all of them?
Oh,
Or did
no,
you add all these up?
I had to put these into a spreadsheet.
Okay.
Yeah. I had to download 10 different strategies. Yeah. Okay, let's go to the next one.
Do you tinker with your strategies?
Pardon?
Do you tinker with your strategies?
Well, I did it first in the sandbox kind of thing to try to develop it. But since then, I haven't touched it. I don't tend to. Otherwise, I eat my own words about not wanting to cherry pick.
Mm-hmm.
However, if we go back No, it's okay, I'll just tell you the story. SectorSurfer decided to make a 2x trade from UWM to, go back one, would you? Oh, yeah. To KRU, which is a 2x bank. I was looking at on my charts, UWM, that's a great looking ETF. Why would I want to trade to KRU, which was at a negative performance at the time? And same thing happened here. I was holding aerospace, and SectorSurfer said trade is biotech. And I says, well, biotech is overbought. It's going to sink. Why would you trade there? Well, it did for several days, and then it came back, and now it's reached new highs again. So sometimes I disagree with them, but what I do is if I still like the ETF or the fund that I was holding, I'll keep it in a separate portfolio. And I'm keeping UWM in a separate portfolio. But I did buy KRU, FBIOX.
With your first 4 strategies, which are all fidelity, which was split alphabetically,
Yes.
you know, there's a scenario where the best opportunities in fidelity all turned up in that first strategy.
I'm glad you brought that up.
So
That
I
was
was
one of
wondering
my
how you
major
address that.
concerns about limiting it to 12 in one strategy, because my valuation looks at probably 100 or more, 140 fidelity funds in one spreadsheet. And like you say, there could be times when all the good ones are in one strategy, you know, the bad ones are in another. I haven't noticed that, but
So you haven't figured a way.
I thought about tinkering it a little bit to see if I could get a little better balance, other than alphabetical. Okay. Okay, now if we look at the combined strategies, if we take all those columns and add them up, year to date, it's 26.55 as of last Friday. And then year by year, all added together. And here's the delta to S&P 500. Sometimes it's a little bit behind the S&P 500. 97 was an exceptional year for the S&P 500. But most years the delta is incredible, like 2008 and some of these earlier years during the dot-com bust. So then I created, well, this was just a convenience column so I could figure out the dollars, but if we'd started with 100K back when, it would be about 4 million now. And I think back, and I started getting into the stock market in 87, just at the time of the Dow Jones crashing. Remember that one? Dropped 30-some%, 87 or something like that. But I was trading in 94. But I don't have 4 million based upon my trading.
Well, now you have SectorSurfer.
But I have now, which I will follow. Okay, one more. Oh, okay, this lists the current market value of each of the strategies I have and percent gain. As you can see, the worst one is the income-oriented one at 8.41. My conservative one, which in past years has saved me. I have a feeling it's going to be a long time again before this particular strategy is going to save me because, you know, bonds have had a big bull run since 82, actually, going back. You know, you remember when interest rates were 18%? And now they're, what's your money market account? 0.1%, something like that.
So these are just year-to-date gains?
These are year-to-date gains, assuming that there was 10,000 put into each one of them beginning of the year for a total of 100. That should have been 100. Oh, it amount invested in each strategy 10K. And then the dollar gain, oh, since 2000, okay, here's a column since 2000. This one, obviously, number 2 outperforms the others, and this sort of answers the question about what happens when you have the best sectors in one strategy. But since 2000, the what I call the boom or bust leverage has gained the most of all.
But Don, I have a question. So are you confident that all those funds existed in 2000?
Yes.
Okay, so that was checked, I see.
Yeah. Well, excuse me. You'd have to go back to another chart, but maybe I didn't put that up. But yes, they all existed in 2000. I'm sorry, they did. Yeah, that's why I picked since 2000. Because prior to that, some of the 2X funds didn't exist. Okay.
So
Next.
the lifetime average there is 2617? Or since 2010, is that?
I think that's just this year, isn't
Yeah.
it?
Yes,
Yeah.
2013 average strategy gain.
I didn't put an average for the portfolio. I could do that from the, since 2000.
And this is all back testing, right? You've been in this portfolio for less than a year, did you say?
Oh, yeah, since May.
You've been in it since May, but all the those results are back tested.
Well, they're from the SectorSurfer's download information.
Everything is back to, everything is fit prior to May.
Everything is what?
Everything is fit prior to May. The only real-time results you have from May.
Right, since May. Okay, let's move. So, kind of in conclusion, my main objectives was to create a group of strategies, put them all together, outperform the overall market, as defined by S&P 500. On a year-by-year basis, there would be no overall, or at least a minimum loss on a year-by-year basis, and achieve those objectives. Secondary objectives, minimize my time in evaluating ETS and mutual funds. Joe knows that at the Lockheed users meeting, a retiree users meeting, that often every month I make a presentation of one sort or another, and all these take time. And my wife is reminding me that the garage needs cleaning out, so I need to free up some time. So I'm still working on the time factor because the SectorSurfer sandbox, which I have totally filled with ideas I'm working on, it's one of those middle of the night things. What if I did this? And I spent a lot of time looking at stocks for a while. Joe and I communicated about that. He can give you a long speech on Investors Business Daily, a group that he belongs to. So I think I've achieved pretty much my objectives. Now, to me, this is kind of just a start. My real goal is to, I'm so excited what Scott's doing with Rising Stars, because my real goal is to get back into stocks. Because when I rolled over my IRA in 1999, just before the dot-com bust, I was trading stocks like crazy, but I didn't realize what was going on. We were in a horrible overbought situation. It was every day some stocks were going up 10, 15%. And boy, I was just rolling in the money. And I thought, boy, I can really do well. And but then the dot-com, and all of a sudden my models didn't work anymore. So I quit doing stocks about that point in time and went into trading just mutual funds. And now I'm anxious to get back into stocks. So that may be a little warning that maybe it's too late. So I responded to Scott's email, by the way, and it says, geez, I really hope that your strategy could have picked up Netflix, LinkedIn, and Tesla. You know, if any of you own those stocks, you know they've done very well. That's the kind of strategy I would like to see that will find a rising star, identify it, and then you move forward with it. Okay, that ends it.
So
Everybody
I have a
listening?
question. Could we back up a couple slides here? Yeah, that one. So on those top 4 portfolios that are Fidelity Select, what if you ran those 4 or looked at the results of those 4 at any given time from SectorSurfer and picked the top 3 from each of the 4? Put those 12 into a new portfolio and use the top 4 out of that instead of the top 1 out of each of these 4. That way you had the opportunity to take the best 4 out of the whole group. You see what I mean?
Can you repeat that?
Make a new portfolio that's the top 3 Fidelity Select funds from each of those 4
Oh, the
portfolios.
top 3 pages.
So you wanna look back at the other spreadsheet that showed all the results?
Yeah, but the top 3 at any one time will change, so,
Yeah, but you're only looking for right now,
right,
right?
Right now.
You're only making a trade right today.
right.
But you, so that's all you care about is right now.
But going across the different strategies, how do you compare them? You have the trend indicator, but that trend indicator is relative.
Yeah, so you're pointing out it's a different algorithm for each strategy.
Yes, and the percentage that's measuring the trend is relative to that strategy.
I'm just wondering if doing what I suggest, even though it changes the algorithm, makes more sense than what this is essentially a random grouping of Fidelity Select, because it's alphabetical.
Right, it's that. I'm sure there's ways to optimize that.
Yeah, what I actually do is I run a scan on the Fidelity funds and I identify the top 12 and then I put them into the first strategy and then it pops out the top 1. And then I run 2 through 13 and that's my second strategy to identify the one I'm going to buy. And I do that 4 times.
Well, that's a good approach, yeah.
But it means that I'm changing it every month. Or at least when a sell signal comes, then I need to go back and run those scans again.
Right.
So it's not a set and forget.
You're not gonna bet. That's-
I wanted to do this one set and forget. I have some others that I look at that are kind of just that. You know, I'll change it every month, or I got some where I change every year
Mhm.
based upon yearly performance, and some that I change every month. Those are in my sandbox.
The note that he sent, Scott sent on Rising Star seemed to be that he seemed to be thinking of it in terms of stocks, but not ETFs. He had a different thing for ETFs, so I need him to do Rising Star for ETFs.
Ask him.
Yeah, better put it in there.
By the way, my ETFs were selected on the basis of which ETFs had the highest volume.
Yeah.
That's how I ended up. I have a list of 55 ETFs that I trade, other than this. And the problem is, every year that list can change depending on the past performance. So I said, okay, well, I'm going to just simplify it. Just choose the one with the highest, that trades the most. And that's how these, you'll notice I picked IVV instead of, I guess, SPY, or, and then I chose, I don't know if I had MDY in that group or not, but sometimes there's other ETFs that are performing better, but it's not the highest volume ETF. So that's another optimization that we have to do.
John, do you have a reaction to the idea of thinning it down that way and changing it, which obviously changes the algorithm each time you do it?
Well, I don't like the idea of changing the algorithm all the time anyway. So doing that, I mean, the ranking is true. You get the top ranked stock in one portfolio, and it could be the bottom, not the bottom, but it could be the low rank in the next one. It depends on the model. And the models are very different depending on what time you make them, what things are in there. You know? So, I mean, it's just a crapshoot.
It's a crapshoot.
Yeah. I mean, I've just regenerated a portfolio and the top one goes to the middle. I mean, it's making a new model. And that new model doesn't necessarily give you the same results as the model you just had.
That's right. Yeah, one of the guys was writing about the energy ETFs being top one model, bottom next model. And he tried to model it with a simple moving average. And Scott says, this doesn't work that way. We have a much more complex model than a
Yeah.
moving average crossover.
Not much.
Not much.
No.
Okay, well, how about a round of applause? I think Rod had a last question. Rod?
So out of all the equities which you put into the model, which were subordinate to your various strategies, then how many positions in different equities do you hold at any one point in time?
Well, I hold one of each, but in my SectorSurfer,
So you hold 10.
I hold 10. But then in my true portfolio, I hold a lot more. Because I have another model that I've been using for 20 years. And I'm kind of comparing this to.
But the results that you showed from punching the history button were based upon choosing the best one out of each 10 in each of the 10 categories, right?
Right.
Over those years.
Right. I'm looking forward $4 million in a few years.
Yeah, oh, great, and we're looking forward to your next presentation. Thank you. Thank you, Don. Thank you, everyone.